I've been interested in business and making money for as long as I can remember. When I first learned that I could make money from investing, I started to pretty much buy every book I could find. Books on trading, books on value investing, even this classic here from Jim Cramer. I fell into the trap that many beginner investors fall into. I thought that I could pick individual stocks that are going to beat the market, but considering that 80% of hedge fund managers can't beat the market, 16-year-old me in my parents' bedroom probably wasn't going to either. But that's not even the main problem that beginners face. 99% of your time should be focused on your career and actually making money in those early years. While you should still be focused on contributing to your portfolio every month, you can get 90% of the upside with 1% of the work simply by investing in index funds. An index fund is a pre-made portfolio constructed to track a financial market index such as the S&P 500 or the FTSE 100. Index funds are going to provide you with broad market exposure and low operating expenses. And in this video, I'm going to show you 3 types of index funds that could make you rich over long periods of time. I'm going to do this for the UK market, but I'll also share a US equivalent for my US viewers here on the channel. When it comes to choosing an index fund or ETF, there are hundreds, thousands to choose from. Being from the UK, it can be a little harder to pick funds as we don't have access to some of the popular funds that you hear Americans talking about, such as VTI or VOO. I'm going to show you 3 funds today that achieve different investing goals, depending on your financial goals, risk tolerance, and where you are in your financial journey. Let's start with total market fund. Total market funds invest in the whole market, whether that be of a specific country such as the US or UK, but the fund I'm going to focus on today invests in the global market. It's called the Fidelity Index World Fund, and this is one of the main funds that I invest in my own portfolio. And honestly, for a lot of people, it could work as a one fund portfolio, or if you're approaching retirement, it could be combined with some bonds in a 2 fund portfolio to limit volatility. Now, this fund consists of 1,510 individual holdings, with about 70% of them holdings being companies in the United States, 14% Europe, 4% UK, and the rest are international. These are developed markets with a clear focus on the US, which I like as that's where most of the growth in stocks has come from in the last 10 to 20 years. And I personally don't see that changing in the next 5 to 10 with the development of AI. The fund also gives you exposure to a wide range of companies that are exposed to different sectors in the US market. You can see the fund is weighted 23% towards tech, 14% to financial services, and the remaining is spread across 11 different industries. This fund works by tracking the MSCI World Net Return Index, and this captures large and mid-cap companies across 23 developed markets. As companies grow and become leaders, they will automatically make their way into the index. This also works in the opposite direction. If companies perform poorly and don't meet the criteria of the index, they will eventually be removed from it. So there's no active fund manager buying and selling stocks, putting hedges on and stuff like that. The index is simply self-corrective based on a set criteria. So this is essentially what I would call a pillar index fund. It's well diversified across a global range of stocks and has a nice mix of growth and value stocks, giving you exposure to the upside of growth, but also having value stocks in the mix to steady the ship in harder times. Global exposure can also decrease volatility as small developed markets can perform well while the US is potentially performing poorly. If we look at the returns this fund has had over the past 10 years, it's had annualized returns of 11.23%. That's pretty damn good. It also has fees of 0.12%, which is fairly reasonable for index funds in Europe. If you're in the US, a fund which has a similar blend of stocks is VTWAX, which tracks the FTSE All Cap Index. This fund could be slightly more volatile as it has international emerging markets rather than just developed countries. So that right there is the main pillar that I have in my portfolio. It's where most of my funds go to, but if you have different investing goals, you may want to invest in these other 2 types of index funds. Next up, we have a growth index fund. Let's take a look at what that looks like. These funds generally focus on investing in higher risk, higher reward stocks that are currently in growth mode. Investors like to invest in these type of companies as they can produce outsized capital gains. Over the past 10 years, growth has been significantly outperforming the general market. However, that was a period of extremely low interest rates, which growth companies thrive on to fuel their growth. So we may not see the same type of returns in a higher interest rate environment like we're in right now. Many companies in a growth portfolio may even be loss-making or just arriving at profitability, which definitely makes them higher risk. These companies usually don't pay a dividend as they reinvest their earnings back into growing the company as fast as they possibly can. So rather than paying that money out to shareholders, it goes into providing capital gain. By investing in an ETF that contains many growth companies, you limit that risk considerably versus going all in on individual stocks. While you may have some losers in the portfolio, you're also picking up the winners along the way. My choice of growth index fund for UK investors is the iShares Nasdaq 100. This fund, as you can imagine, tracks the Nasdaq 100, which gives investors exposure to the largest, most innovative non-financial stocks listed on the Nasdaq stock market. It has an expense ratio of 0.33%, which is much higher than the Fidelity World Index. Most growth funds do have a slightly higher expense ratio than a standard fund. This is just something you'll see across the board. The fund contains 101 holdings across multiple different industries, so you are getting diversification. The fund is heavily weighted towards tech, with over 50% of the stocks are in the tech industry. However, it also includes innovative companies in other sectors, such as communication, consumer discretionary, healthcare, and others. The top 10 holdings consist of Amazon, Apple, Microsoft, Nvidia, Meta, Broadcom, Google, Tesla, and Adobe. So even though a growth portfolio consists of companies that are fast growing and you might think of little startups, they're still fairly large companies. It's only recently that Amazon became profitable. They've been growing at a massive rate, and Jeff Bezos is notorious for this. He kept Amazon at simply, kind of break even for a very long time because he just simply wanted to pump all of the profits back into growing the company and making it bigger and bigger and bigger. And shareholders of Amazon have benefited massively from that. So while growth can be more risky and volatile, you're not investing in little, penny stocks. It's still good quality blue chip companies. If we take a look at the returns of this portfolio over the past 10 years, they're considerably higher than the S&P 500 or the Fidelity World Index. The annualized returns over the past 10 years is 16.26% per year. This may seem great initially, but the volatility of this is just significantly higher with this fund as well. During downturns in the market, a growth fund is likely to get hit much harder than a total market fund. During the 2022 downturn, the iShares Nasdaq 100 fund dropped more than 35%, while the Fidelity World Index only dropped 10.7% in the same period. If you can stomach these drops, you could potentially come out the other end with bigger gains, but for beginner investors, it can be extremely hard not to sell during these times. I prefer to have some growth stocks in my portfolio, but as I mentioned previously, have the World Index as the ETF that steadies my ship. It's that pillar ETF, and I'll add growth onto it. If you look at the period from 2022 to today, both have actually had very similar returns. Both just lost very slightly at a -2%, but that's been a pretty poor period. But if you look at the chart here, you can see the massive dip that the growth portfolio had. So while both of these portfolios got you to the same place, and if growth continues in 2023 and the markets continue to trend upward, the growth portfolio might actually take over and give better returns. However, during the down period, it's extremely hard to stomach that dip. If the market continues to rise in general, you'd probably expect to see growth outperform the world fund. Over the past 5 years, the iShares Nasdaq 100 has had total gains of 120%, where the world index only had 57%. So I do like to have growth in my portfolio, but as a smaller percentage, as I personally don't enjoy seeing my net worth swing 35% at a time. Investing in growth stocks is more beneficial for younger investors who can take on more risk, as they have longer to rebound from market setbacks. If you're in the US, QQQ is an index fund that also tracks the Nasdaq 100 and is a great choice for investors over there. What if you want to actually generate income from your investments? That's where dividend index funds come into play. If you want to generate income from your investments, investing in a dividend ETF can be a great way to do it. Dividends are a share of the profits that companies pay out to their investors. The amount they pay out is known as the yield. Generally, this is between 2 and 6% per year. Some pay higher than this, but it's usually a red flag as the company is trying to attract more investors while hurting their bottom line. If it's too good to be true, it probably is. Most companies pay out a dividend quarterly, with others paying them twice a year or some even paying monthly, which lots of dividend investors like to see. Seeing your first dividends come in from investing can be extremely motivating and can continue to push you with your investing and growing that dividend yield over time. Companies that pay a dividend are usually also more mature and produce consistent profits. While they may still grow, it's usually at a slightly slower rate than younger companies which are in growth mode. Some investors follow the dividend snowball method. This is where you invest in dividend companies and then use the dividends that you get from the companies to purchase more shares of those companies. And this allows you to build a bigger position in the company and increase your yield from the stock over time. Rather than spending lots of times researching individual dividend stocks, invested in a dividend ETF is a great way to get exposure to great dividend companies and start collecting dividends. Some dividend investors have the sole goal of just living off dividends from their portfolio that pays them, rather than focusing on the capital appreciation like growth investors do. One of my favorites in the UK is the Wisdom Tree US Equity Income ETF. It seeks to track the price and yield performance before fees and expenses of the Wisdom Tree US Equity Income Index. The fund has broad diversified exposure to high dividend yield equities which meet Wisdom Tree's risk screening criteria. It has 371 holdings, with 99% of them being in the United States, and an expense ratio of 0.29%, which again is much higher than that of our total market fund we talked about first, but that is again pretty standard for a dividend ETF. The fund has a current dividend yield of 4.69%. However, as the price of the fund changes, the yield is also going to change. Companies may increase or decrease or even cut their dividends altogether. So if you invested £100,000 in this fund, you would receive approximately £4,690 in dividends each year. If you continue to reinvest your dividends, your yield on your initial investment will continue to increase over time. And this is really the dividend snowball in effect. As you invest more money, you get more dividends, and you put more of them dividends back into the company, which buys you more dividends. And it just is a snowball effect. The more you do, the more you get. And that is a really fun part of dividend investing. So let's take a look at some of the stocks that this portfolio holds. Some of the top holdings include companies that have been around for decades, including ExxonMobil, Coca-Cola, Pfizer, Verizon, and much, much more. So as these stocks are mature and paying dividends to shareholders, they're unlikely to grow as fast as growth stocks would, but some of them have still grown significantly over the past 10-20 years. However, it definitely affects the returns that this type of ETF will get. Let's take a look at the returns of the Wisdom Tree US Equity Index over the past 3 years. Over the past 3 years, it's had a 9.64% average return, but it has only had a 5.37% return since its inception. So while returns aren't quite as large, you do get more stability and income from this type of fund. It's also worth noting that the Fidelity World Index also has a dividend yield of 1.79%, but the version that I showed you above from earlier is an accumulation fund, meaning that the results that I showed you are from dividends being reinvested automatically. I'm just editing this video right here, and I just wanted to interject for a quick second to say that this dividend ETF doesn't have a huge amount of assets under management, which isn't necessarily a bad thing. However, whenever it comes to selling, you could have trouble selling if there's just not much liquidity in the market. Wisdom Tree is a newer company. The companies in that ETF are still great, and I think it's a good portfolio. However, there is other options out there. Another option is the FTSE All World High Dividend Yield ETF, VHYL. It's another good option which has billions under management. So if that is a concern for you, that may be another one to check out. But I'll continue on with the original video. If you're looking at a similar fund to the Wisdom Tree fund in the US, SCHD is a good start. And that's it. Those are my 3 favorite ETFs to invest in the UK. If you want to start investing in some of these, you can do it through Hargreaves Lansdown, which I will leave a link to in the description. Obviously, past performance is not indicative of future results, and your capital is at risk when you invest. Some of these index funds aren't available on platforms like Trading 212. Honestly, I'm not too sure why, but you can find them on Hargreaves Lansdown. Again, I'll leave that link down below in the description. If you want to learn how I built a 6-figure portfolio by the age of 26, I'd recommend checking out this video right here. Make sure and subscribe if you're new here, and I'll see you guys in the next one.